Welcome to Volatility Trading Strategies. So for those of you who've had a chance to watch some of my other videos, you may have noticed that I rarely talk about annual returns without also mentioning some risk-adjusted metrics to go with them. And the reason that I do this is because annual returns on their own are meaningless. Yet when we see the media talking about investment results and other fund managers talking about their performance, this is very often the only number that we see. We see that X% rate of return. And you can see traders on Twitter and YouTube talking about their performance. Maybe they made 100% in any given year, which on the surface it sounds good, and it's definitely good for marketing. It gets people excited. How can I make that much money? But the problem is we don't really know how those returns were achieved. Was it the result of trading skill? Or was it just simply because they took on excessive risk, and because it's a bull market, it happened to work out well for them? Should we expect those results to continue going forward? Or is the volatility too high and the drawdowns too large? Maybe its days are numbered. The only way that we can answer that is if we actually quantify what the risk-adjusted return is. So what I want to do is introduce what is the most commonly used, and fortunately for us, the easiest to understand, measure of risk-adjusted returns, which is the Sharpe ratio. So the Sharpe ratio is just a way for us to measure the portfolio return in relation to the portfolio risk. And this is the formula here. It's actually really simple. It's just the return of the portfolio itself minus a risk-free rate. I always use short-term U.S. Treasuries here, and because interest rates are so low right now, I use 1% for all of my calculations. And then we're going to take that whole thing and divide it by the portfolio risk. Another way to view that risk is just the standard deviation of the month-to-month returns. So if you're having a lot of big wins and then a lot of big losses, that's going to increase the volatility of the portfolio, and it's going to affect that Sharpe ratio. That's essentially what we're trying to calculate. So here's an example of a portfolio that returned 13%. It had a standard deviation of 12 and that risk-free rate of 1. We would just do 13 minus 1 divided by 12, and we get a Sharpe ratio of 1. Now a Sharpe ratio above 0 just represents that the portfolio itself is a better investment than the risk-free rate. If the Sharpe ratio is negative, then it would mean that the portfolio is actually a worse investment and you'd be better off getting the U.S. Treasuries. So the higher the Sharpe ratio, the better, essentially. Just to put this in a little bit of context, the S&P 500 over the last 10 years has a Sharpe ratio of about 0.3. So while it's definitely better than a risk-free rate, it's not actually that great of an investment. So now we can go through an actual example. What we're looking at here is two funds. Fund A has a rate of return of 20%. Fund B of only 10%. So which one would you choose? Of course, most people would look at this and say Fund A is twice as good as Fund B, and you definitely want to put your money in Fund A. But we know that annualized returns on their own mean very little, so we need to add a little bit of context here. When we add in the risk column, we can see that Fund A is definitely more volatile. So now it's not so clear which fund we want our money in. Fund A does return more, but it's also a lot more volatile. Fund B returns less, but from month to month, it's pretty stable. So now adding the Sharpe ratio, of course, it becomes clear. While Fund A did return more money, Fund B is definitely the better investment. The higher the Sharpe ratio, the better, and Fund B with only 10% return, but very consistent, is a much better investment in this case. But the Sharpe ratio can be used for more than just determining which fund is a better investment. It can actually help us build the more stable portfolio. So now I'll go through an example from our real portfolio to illustrate how we go about doing that. So the Total Portfolio Solution is just the diversified portfolio that's made up of all three of our trading strategies. So you can see all three of them have an allocation in the fund. And then the results down here, annualized return, we're not going to get too focused on that. Here's the Sharpe ratio right there at 2.15. So because the derivative strategy was the last one to be added to the fund, what I want to do is use the Sharpe ratio to illustrate how we're able to determine whether we should add that in or not. So we're going to keep this 1-to-2 ratio between the volatility and the balance strategy, and I'm going to change this to 33.3 and this one to 66.6. So it's still the same 100% allocation, but now it's only going to be 2 funds instead of 3. And we're going to use the Sharpe ratio to determine whether we should be adding in the derivative strategy or whether we're better off without it. So this second fund is the Total Portfolio Solution as it currently exists, with the derivatives fund in there. So this is the 25-25-50. And it has an annualized return of 29.35. However, if I remove the derivative strategy and just do a 33.66, you can see the annualized returns are actually a little bit higher. So the question is, why would I want to include those derivatives at all if the rate of return is actually getting lower when I do that? When we add in the standard deviation, you can see it becomes a little bit more clear. The fund as it exists right now, with all three of them in there, it does have lower volatility. The question is, when we calculate the Sharpe ratio, is it enough to make up for the fact that the annualized returns are lower? So there's the Sharpe ratio, and this is the fund as it is now of 2.15. If I remove the derivative part of the strategy, it does return more money, but it does also increase that volatility, and the Sharpe ratio goes down. Remember, the higher the Sharpe ratio, the better. So in this case, again, even though the returns are a little bit lower, by far the better investment is when all three of the funds are in the total portfolio solution. So the Sharpe ratio is very helpful in this case for allowing us to determine whether diversification is actually diversifying for a purpose or whether we're just adding something for no reason at all. Oftentimes you see in the financial industry, you get portfolio managers who they're telling their clients how diversified they are. They may say that we're in stocks and bonds and precious metals and real estate, and we're not just in stocks, we're in international and domestic stocks, we're in large cap and small caps. We're not just in bonds, we're in long and short duration, we're in high and low yield, different credit ratings. We don't just trade gold, we trade silver and platinum as well. And it all might sound very diversified. Each fund, mind you, probably has its own management expense ratio, so you have to keep that in mind. But it all sounds very diversified. The question is it diversification with a purpose? If they just give you a laundry list of all the funds that are in your portfolio, and don't give you any context, like a Sharpe ratio, for example, how are you supposed to know whether it's even useful to be adding so many different funds into the same portfolio? So if we want to make a good rate of return in both good times and bad times, we want to have a portfolio that is sustainable in the long run, we need to look beyond those annualized returns, and we need to really focus in on the risk-adjusted metrics. So in future videos, I'll talk about the ULSR index, about correlations, about maximum drawdowns, and combined with what we now know about the Sharpe ratio, it'll help us make better investment decisions. So thank you very much for watching, and I'll see you next time.